Gentleman from Nebraska, the chair of our Housing and Insurance Subcommittee, Mr. Flood, you're recognized 4 or 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, later this week, the banking agencies will be proposing changes to the Supplementary Leverage Ratio, which we think are long overdue, considering the Fed in 2021 indicated that they would soon put out proposals for reform to the SLR and never actually did. However, our understanding is that the proposal being considered this week will not allow for treasuries to be excluded from the SLR calculation. Secretary Bessent earlier this year had argued that such a change could serve as a boost for banks and their ability to intermediate in the treasury market and could potentially pull treasury yields down 30 to 70 basis points. Chairman Powell, do you agree with the Treasury Secretary's comments on the potential positive impact of SLR reform on the Treasury market, and what is the rationale for not excluding Treasuries from the SLR calculation in the proposed rule?
So I agree that when the leverage ratio is binding, it discourages banks from undertaking low-margin, fairly safe activities such as mediation in the Treasury markets. So this should encourage more mediation. I don't have a numerical estimate of how much that would matter, but I do think it would matter. I think it was important. I've supported leverage ratio reform for a very long time, since before 2021.
Chairman,
in terms of the structure of the thing, I think we're seeking comment on a particular proposal that doesn't involve exclusion, but we're also asking a question about exclusion.
Mr. Chairman, considering the Fed temporarily excluded Treasuries from the SLR calculation during the COVID pandemic, were you aware of any safety and soundness or financial stability problems that arose as a result of that decision? And if not, why was that relief terminated in 2021?
So that was an emergency measure. From the beginning and end, it was an emergency measure. I think, you know, my long-held view is that we should have a permanent measure, and now we're going to. And you know, we have an open board meeting on Wednesday afternoon, and after I finish my hearing on the Senate side, and I'm very much looking forward to putting this proposal out for comment.
Thank you. In March, the Federal Reserve, together with the FDIC and the OCC, announced that they intend to issue a notice of proposed rulemaking to repeal the 2023 Community Reinvestment Act and replace it with the legacy CRA framework. Nearly 3 months have passed since this announcement. What is the status of this project?
Well, we're going to do what we said we were going to do. It's just a question of execution, and I think you'll see that coming. This would be so Vice Chair Bowman has the job of sequencing these things, and that one's certainly coming.
Do you intend to issue a proposal that will be a clean rescission and replacement of that rulemaking, or are you considering amendments to the legacy rule?
I honestly don't know. We'll come back to you on that.
Okay, so we should know more later this week?
We might, yeah.
Okay. Finally, I'd like to build off of what Congressman Stile asked previously on the Supervision of Novel Activities program. Do you feel any changes could be made to it to encourage innovation, and do you anticipate any such changes to the program?
I do, and I also think Governor Bowman, now Vice Chair Bowman, is someone who is actually deeply knowledgeable and experienced in supervision, and that hasn't really been the model. We've more had people who are experts on regulation. I think she brings a particular ability to move supervision in a healthy direction while also preserving safety and soundness. And that's what you mentioned is one of the dimensions in which I think that will be true.
Thank you for your testimony today. I appreciate your service to the country. And with that, I yield back, Mr. Chairman.
Thank you.